name is Nelly Siwe from Kwela Women, and we are an NPO that was founded in 2018 with the idea behind this NPO Grow series is to find inspiration and to connect with each other and share ideas, especially in a time that we need it the most. So before we begin today's session, I would like to start off with some housekeeping announcement. Please note, we will be recording today's webinar, and this webinar will be shared on our social media platforms, as well as our NPO Grow newsletter. So if you haven't already subscribed, I would definitely recommend that we also subscribe to the newsletter. Also, follow us on @Kwela Women to join in on the conversation. And today we will be speaking about accounting best practices for NPOs. We'll also be wrapping up today's conversation with a Q&A. So please do prepare your Q&A and just post it in the chat section at the end of this on your screens. So in today's session, we are joined by Gerhard Louw, and Gerhard is a financial systems manager. And before we kick off today's session, I'm not sure if Gerhard has already joined us. There is.
Hi, Emily.
How are you?
Good, thanks.
Good. Thank you for joining us. So before we get into today's session, I'd just like for you to take a minute or so just to introduce yourself, to tell us more about what you do, and so forth.
Great, thanks for having me, Nelly, and for Kwela Women as well. I just want to apologize for some background noise. I live across a French school, and I think they have break at the moment, so you might hear some screaming kids in the background. So basically, as you mentioned, I label myself as a financial solutions enabler or financial systems manager, and basically what that entails is making use of technology for companies to better manage their financial aspects, whether that's accounting, management accounting, or even the systems within their company. I think in today's world where everything is so digital and so fast-paced, companies need to adapt and make use of digital platforms and ecosystems to actually gain a competitive advantage. And the companies that come to mind are the Ubers and the Airbnbs of today. And they've managed to do that, to approach businesses in a different way and making use of technology to actually connect different people and create those ecosystems. So they don't necessarily own the assets, but they merely manage them by making use of apps and things like that. And so I'm broadly involved with helping companies set up financial systems, digital systems, like accounting systems, and integrating these with their other systems, whether it's operational systems, HR, or payroll systems, just to be able for them to analyze their data more than actually compiling it. And they are then able to react to a changing environment quicker as well and make decisions that actually benefit them in the economic environment.
Perfect stuff. Thank you so much for that lovely introduction. So today we're going to be speaking about accounting best practices for NPO. So whether you are a new, small or large nonprofit, we all know that accounting is something that we must all stay on top of because it is serious stuff. Because correcting careless mistakes on financial reports often costs us a lot of time and money. Investing knowledge in skills and resources to get it right the first time is often a better idea. So Gerhard, you're the expert, so I will leave it all up to you.
Okay, thanks. I'm just going to share my screen. Just want to confirm if you can see my screen.
I can see it.
Great. Okay, so today we'll be looking at accounting best practice for NPOs and social enterprises. And I guess the whole idea of this is to do the simple things right. accounting is not the main function of an NPO or a non-profit company, but it can be something that is very difficult for NPOs to do, and it shouldn't be. I think in the technological environment that we find ourselves in, it's something that should actually give an advantage to NPOs to get funding from funders. So what we will be looking at is just understanding the landscape of non-profits, just to see the different reasons why you would either be an NPO or an NPC, and how that helps you with accounting and compliance as well. Then we look at the 4 pillars for accounting for non-profits. And we'll also be talking about how do we measure success in a non-profit, as you don't have revenue, so you can't see your growth in revenue necessarily, or your return on equity, as there is no equity. And then lastly, we'll just touch on how you can use technology and what is available in the space for non-profits that they can use to better account for their activities. So if we look at the non-profit landscape, there are many types of non-profits that you can be, or statuses, and I think sometimes it's quite confusing. What is the difference between an NPC and an NPO and an NGO and a PBO? And it can also be quite difficult for companies to understand what are they. So NPC is a non-profit company, and that's registered with SIPC. And the main reason you'll do that is for credibility, because you have to adhere to the Companies Act, and you're also automatically registered for income tax with SARS. A volunteer association is just people that come together, let's say a soup kitchen or neighborhood watch, and they agree their own terms, and there's no statute or law that governs that. Then we have an NPO, which is just, which can be a non-profit company, a trust, or a voluntary association. So you are an entity, but you want an NPO status, and this is registered with the Department of Social Development. And you would want that, for instance, if you want lotto funding, that's a requirement for an NPO. An NGO, on the other hand, is actually just a term that's used to define some non-profit companies, NPOs or volunteer associations. And that is mainly on the scope of what that organization does. And it's usually independent from government, and they promote change on a very broad level, whether it's geographical or it's a faith-based organization. And so they impact a large community. That wouldn't be your soup kitchen, for instance. It might be a wildlife association. Then we have a trust. You get what's called a public benefit trust, and they are highly regulated by the High Court. A magistrate is appointed to the trust as well, and this is mostly to safeguard fixed assets that has an extended lifetime. Let's say a sports ground in Khayelitsha that might be there for 20 years, and someone needs to manage these assets. And then lastly, we've got what they call a PBO, or public benefit organization. And
I think we've just lost Gerhard there for a bit. Okay, so just a quick reminder while we all wait, because I think we have lost Gerhard there for a bit. So if anyone has any questions, I think now is the time to prepare all our questions and put them in the chat section. And as soon as Gerhard gets back online, then we will continue with the discussion.
It seems like my computer just decided to switch off for some other reason. So I'm not sure where you lost me there.
You were still taking us through the public benefit organizations.
Okay, yeah, so public benefit organization is not a legal entity or a form. It's simply a status that SARS awards you if you comply with Section 30 of the Income Tax Act. And basically what that means is that you are exempt from income tax. So you don't pay tax on your donations that you receive. And you can issue Section 18A receipts. So if someone donates funds to you, you can issue them with a receipt that they can then use for tax benefit on their income tax, whether that's an individual or a company. So that's more or less the non-profit landscape, and we'll see a bit later how that influences our accounting decisions and practices. So if we look at the next point, which is accounting for non-profits, historically accounting was about historical information, and it was just to give a version of the truth that was unbiased, and it was only for specified period. And that has changed in today's world to encompass a bit of a broader of the four pillars of accounting in today's world. So we have financial reporting, which is very similar to traditional accounting, where we give an accurate account of the financial state of a company in a timely manner. Then we have compliance, and this has to do with the external regulatory requirements and internal controls within a company. We have Treasury, and that has to do with managing the cash flow within an organization to ensure that we can meet the obligations and still have an impact in the environment. And then lastly is management accounting. And this might be something that you would associate with a manufacturing company, but it's a great tool for nonprofits to actually do scenario planning, to analyze their costs, because in theory, nonprofits only have expenses. They don't generate income necessarily, and it helps them to adapt their costs and their strategy based on what's happening in the environment. So if we look at financial reporting first, which is one of the first or the first pillar, we would say that the main function of this is to provide an accurate account and for external stakeholders. And this is very important, that when you actually compile your financial reports, think from it for the perspective of an external person, a funder, the bank that has to look at your income statement and your reports. This is the person that you're creating the report for, and it has to make sense to them. And a good reporting practice has four characteristics. The first one is that it should always be accurate. And this creates trust for funders to have confidence in what you say is actually true. So it has to reconcile to your bank and to other third-party figures. It has to be standard. So that means that you need to be able to compare to the previous year. So you should pick a layout and try to stick to it in order to compare to previous periods as well. It has to be timely. So financial reporting should be something that's done on a monthly basis if you can. And this is just to highlight the funds that you need. There's no use if you take 6 months after the financial year to generate financial reports and then only give it to funders. Then you're halfway in your new year already, and you might miss funding opportunities. And then objectivity. So very important that you actually make use of an external accountant or an auditor or a registered person to compile the financial reports for you. And that just gives credibility to what's in the report is actually the truth. Now, a good way to set up your financial reporting and to break it down for these external stakeholders to make more sense in their eyes is to make use of different cost centers or cost categories. So I'll show you in an example where we take the admin cost or the overheads, and these are usually fixed. We look at the objective or the program costs or any cost that is associated with your initiative. And this depends on the donations that you receive and the need for your organization. And then the last one is fundraising. And that's very important that you show that you are actually actively engaging and thinking about fundraising. They say that it takes money to make money, and that's very true for nonprofits as well, is you have to engage in fundraising in order to raise money as well. So if we look at this simplified income statement, you will see that we have our three cost centers: fundraising cost, initiative cost, and admin and overheads. And the first thing I want you to notice is that each one of them has employee cost as part of that cost center. And this allows you to show how effectively you are using your human resources. And employee costs are typically also the biggest expense for nonprofits and for other companies that do services. That's not necessarily someone that manufactures something or that buys raw material. And this will just allow you to see how effectively are you using that employee cost, and if you are overcapitalizing cost in a certain area. This will also allow funders to see how you manage the cost overall month to month. For instance, you will see that the overheads are constant, and that shows that you are able to scale these costs when you have more beneficiaries. This cost will go down per person that you actually impact. And it will also show that, let's say, if you spend a lot in fundraising, there's an increased donations that's received. So you can see a direct correlation in the cost spent and income generated. You can also break it down in a percentage of total cost to see how effectively you are managing your funds in terms of cost centers. And that just makes it a lot easier for you to manage internally, and it makes sense to funders when they look at how you are actually apportionating the funds that they give to you. So if we look at compliance, which is the second pillar for accounting, compliance is a trust system for external stakeholders, and this is about rules and controls. Now, the good compliance practice is to ensure that you have up-to-date information. So you should regularly update all of your documents, and we'll see what those documents are just on the next slide. It should be administrated. What that means is you should have a dedicated person that administers all of these compliance documents, and it's easy to access for everyone in the organization. So if a funder asks for something, it's quick and easy to give it to them without an hassle. Then engage is the next one. So it's always good practice to engage with the people that you have to comply with, whether that's SARS or your tax practitioner. Building that relationship with them makes it easier when you come to applying for your compliance or verifying or being audited. You have that relationship with them, they know what's going on in your company, and that just makes the compliance process easier. And then the last one is diversify. So as a nonprofit, try and be compliant to as many things as you can. A lot of the time you will have a funder that's in a specific sector or industry, and they want some strange compliance confirmation from you. And then that might take you 3 weeks to get compliant, or there's issues in your tax clearance or your employee tax, and you're losing all that time where you could have raised funding already. The big thing here is, I think sometimes people think that compliance is just a tick box exercise and it's filling in papers, but it is a system of trust for funders and for banks. They know that it's easy to maybe fake 1 or 2 documents, but that's why they ask for a list of documents. It's not that easy to fake everything and that everything talk to each other. And that's a big thing about compliance for external funders and other parties that you'd have to deal with. So if we look at what are these external compliance things that nonprofits typically have to comply with, and what I would suggest the most important ones are obviously SARS. So if you get that public benefit organization status, You only have to apply to that once, and then you have to comply with the Act in terms of what you do as an organization. Your tax clearance, make sure that's up to date at all times. So that just means submitting your income tax returns on time, your EMP 201 submissions if you have employees, and making sure that that's up to date so that you can just produce a tax clearance. CIPC and the Department of Social Development. So if you're a non-profit company, you have to submit an annual return. And if you're an NPO, you also have to submit an annual return. And when you change any of your directors or member details, you have to inform these parties immediately. So they might ask for a proof of address. It's different from SIPC. Then you have to go back. So making sure you keep this up to date as soon as it changes. The other one that they love to ask for is your FICA documents. So that's the proof of residence for the organization and the members, usually certified ID copies and a bank confirmation letter. And you'll see all of these usually not older than 3 months. So it's important to, when that 3 months pass, to update these documents, have them ready. Sometimes a director might be on holiday, or they might not be available or in hospital, and then to get that document can be difficult. So keeping that up regularly up to date just makes it easier. And then also a power of authority to sign resolutions. So maybe you have one main member or director that has the power to sign documents for the next 2 months or 1 month, and you can update that on a regular basis. Then the last one is a BE certificate. So just to get that beneficiary status certificate from a BE agency makes it easier for you to get funding as well. And from these external compliance, you can see that being a non-profit company versus an association or trust, it's a lot easier to comply, because you need to have a registration number to to get a BE certificate in most cases. To get proof of residence for a voluntary association is very difficult. You need letters of confirmation. If you're a non-profit company, it's easier. The same with a tax clearance. If you're a non-profit company, you automatically get an income tax number. It's easier to get a PBO status. The other important thing with external compliance is let external people assist you. They are the experts here. Rather pay someone a small fee to get you compliant, and it's not something you have to worry about. This does not necessarily create direct value for your beneficiaries, but it has a massive impact on your ability to actually raise funds. And then again, we said that having it administered is very important. Save all of these documents online, like on a Google Drive, a Dropbox, or a Microsoft OneDrive, and everyone in your organization can have access to this information when someone requires it. If we look at internal compliance, these are things that funders, banks, and other organizations look at within your organization to see if you have a good accounting practice. The first one is meetings. Having regular meetings, not just the annual general meeting, is very important. This shows that you're engaging on important topics, agenda points, and actually signing resolutions and adoption notes if important decisions are made in those regular meetings. Shows that you are following a process within your company. Payments, this is probably the biggest thing that external funders are nervous about. If they give you the money, what will actually happen to it and who has control over it? So having more than one person authorize a payment, so segregation of duties, one person will load it, another one would actually press the pay button on the bank. Keeping a record of all payments made. Also very important, making sure you have a source document from a third party, whether that's an invoice or statement from that party, and especially for reimbursements to employees. Funders can get very nervous if there's money paid out for claims by employees, and it does not always look that great if you can't produce supporting evidence. Then policies. And in terms of a company's policies, everything that the nonprofit should be influenced by its mission, including its policies. So ensure that you have rules in place of how things are done. So if you receive a donation, should it go into a register? Do you write it on a big board for everyone to see? And make sure that these policies are also available to all employees so that they know how things are supposed to be done. If they need to be a whistleblower, it's easier for them as well. And then make sure that you have conflict of interest tests and declarations. So when you have a new employee or supplier or donor, let them sign a declaration that says that there's no conflict of interest with the money that they are donating. It's because some people might ask questions, and then you can produce that immediately. And then again, very important, transparency in everything. You should be comfortable to post your financials online, in a sense, because if you can't do that, then you won't feel comfortable to give your accounting records to a funder either. So transparency is a very important part of policies. And then the last one, accounting for internal controls. Ensure that they are up to date. So that means not 2 months after the month end. This can be on a weekly basis. And that just allows you to spot unusual activity if something is wrong. And reviewing the figures regularly. Again, that review action allows you to see if something is happening. And a good practice as well is to report the figures to members or directors or senior staff. And this ensures that they also engage in the accounting and ask questions. And it's always good to have other inputs in the accounting figures as well. And then lastly, again, have this reviewed by an external accountant or auditor to sign it off, to give you that peace of mind that what the employees are doing in terms of accounting is correct. Now, internal controls ensure that members and directors are protected and create trust for all employees and external stakeholders. And that's the main reason for internal control, again, is trust and credibility. If people want to give you money, it's difficult to part with money, and this just makes it easier for them to feel comfortable with that. Okay, the third big pillar is treasury, and that's just keeping on top of your cash. So again, what does this do? It creates confidence in management, employees, and external stakeholders. It's that trust and credibility, but it also informs your approach and ensure that you can adapt to circumstances. So treasury management and managing your cash should be something that's proactive and not reactive. It's something that you should know beforehand, before you start getting into a cash situation. So the good practice for treasury is visibility. So know your cash position at all times to inform what you're going to do with that cash. Plan for the future, create a cash runway in line with your goals, and we'll look at an example of a cash runway. Be smart, so invest any excess funds in an interest-bearing account that you might have access to. You get shorter and longer notice accounts, but show that you are actually investing that money for funders as well. Inform your status, so use your position as a non-profit to negotiate extended terms or to get additional discounts. So again, if you have a BE certificate, those companies that give you discounts or terms can also get a benefit out of it. And many organizations actually give additional discounts or reduced prices to non-profit companies if you ask them. And then lastly, invest in your mission. Again, use cash to generate cash. It's important to actively fundraise and set costs aside for this, and you can measure that success. And we look at how do you measure how successful your fundraising was as well. So this is a cash runway example. You'll see our 3 cost centers that we had originally: the fundraising cost, initiative cost, and overhead cost. Is split per month for the whole year. So we're looking at a 12-month cash runway. And this is the total expenses for each month. We would compare that to how much cash we have in bank. And this will just inform us at which stage are we about to run out. And in this example, it would be in July, and this will inform you to either reapportionate cost to different cost center to try and reduce it, or maybe to take some of this budgeted fundraising cost, fundraise a bit harder, and see if you get that return. So this is again something you review very regularly to see how it changes and to adapt your costing strategies in order to make the most of the cash that you do have in the bank. So then the last one is management accounting. And the main idea here is that you plan for the future and change, and you engage with the change that's happening. So a traditional accounting and what we've looked at now is mostly based on history and what has happened in the past. But accounting is a great tool to actually proactively plan for the future and to analyze your costs. So the good management accounting practices are to plan, so create a budget for yourself to set the tone for a specific period that's in line with your deliverables. Review this plan regularly. So compare how much you've actually spent to what you've budgeted. Rethink, so adapt your approach based on the results that you saw here in the review, and then scale. So look at your expenses like you would a manufacturing business and treat them as direct or indirect costs. And this will drive your mission execution. And I'll show you an example of how you can use the scale to actually see how to better plan and ask for funds. So having a plan that is reviewed regularly allows you to celebrate small wins and adapt in time to make sure you can fulfill your organization's mission. So if we look at actually scaling your business, and again, I'm using the same three cost centers. We have fundraising cost, initiative cost, and overheads. And then I've added another part here called people helped, and you can see that increases every month. Then we look at the initiative cost and the overhead cost separately. So initiative cost is what you would call a direct cost, because it should increase the more people you help, and the overhead cost should be constant. So we would look at the initiative cost in January is 115,000 Rand, and we've helped 10 people. So that was 11,500 Rand per person. The overheads, a similar approach. So the 22,300 in January, we helped 10 people. So our overheads per person was 2,230. Now, if you look at the overheads, and that's the yellow columns here, you will see that it decreases the more people there are because the cost stays fixed. So the more people you can help, the less your overheads become into infinity in theory. In terms of your initiative cost, what's typically true here is that initially it is quite expensive per person, but you get to a stage where you are able to achieve economies of scale because maybe you have higher buying power, and you can get better prices, or the cost, you can decrease some of the costs that relates directly to the initiative. And that, as you can see here, it should start to become a standard or more or less specific cost per person. And here we can see it's around 3,000. Now this informs you, you might be in February and it costs you 12K per person. And it's difficult to go to a funder and say, I need a 12K to make a difference in my mission. But it's a lot easier to go to someone and say, it will only cost you 3K to help someone. Why don't you help 4 people? And that's how you can scale. If you can see what your costs are per person, if you ramp up your scale, it's a lot easier to fundraise and to get funders on board instead of showing them this costing, and that's a bigger commitment and you're only helping 1 person. So looking at it from a manufacturing perspective, if that makes sense, helps a lot in scaling your fundraising as well. So if we look at fundraising, which is the cost we didn't address in the previous slide, we can see that this is the fundraising cost on a monthly basis. Now, obviously, that depends on your initiatives that you do. And then here we can see what's the funds that were actually raised each month. So what you can calculate is a return on investment. So you can look at your cumulative funds raised. So in January we raised 10K, in February 20K. So cumulatively in February it's 30K. And then we compare that to our cumulative fundraising cost. So in January our fundraising cost was 51K, in February 11K. So total February it's 62K. So we have spent to date in February 62K, but only raised 30K worth of funds. So that will show a negative return on investment, which is just those two summed together, divide by the cost. But as you go on in the year, you can see that we are starting to actually make a return on our investment. If we look at May, our cumulative fund raised is 160K, but we've only spent 106K. And this is how you can inform your fundraising mission and to celebrate your funds raised as well, and to justify why you spent that cost on fundraising, or maybe to change your approach to your fundraising cost if this return on investment does not become positive. So it's better to look at this in a cumulative basis rather than a month-to-month basis. Okay, this takes us to the third part in the presentation, which we are measuring the success for nonprofits. Now, typically a company would measure their nonprofit margin or their return on equity, but nonprofits don't have these measures. So they have to look at it in a different light. And we can use something called the 3 E's, which refers to effectiveness, economy, and efficiency. And I'll also take us through a simple example just to demonstrate how you can use it. So effectiveness is usually a non-financial objective that the company has. For instance, the number of people impacted or the number of people fed, if that is your goal that you have or your mission as a non-profit. The next one is economy, and this refers to the cost of your resources and how affordable it is. So if you budget X amount for a certain cost, like telephone expenses, and you can get it for 20% cheaper, then you're achieving economy on that specific cost. And usually you measure that as your actual cost versus your budget. And then the last one is efficiency, which refers to the inputs and the outputs. So how effectively are you using your inputs to achieve your goals? And this you can measure as a percentage of each, which I'll show you in an example. So just in other words, again, economy is getting the right inputs at the lowest cost or getting a good deal. Efficiency, which is the measure of the two, is getting the most from the inputs or getting a lot for the efforts that you put in. And effectiveness is getting the results from the outputs or doing the right thing. So actually measuring your overall goals. So if we look at an example of how you can practically use the 3 E's, effectiveness again is your output. So in this example, our goal is to feed 10 people. We've managed to feed 8. So our effectiveness is 80% or 20% under where we want to be. So we're 80% effective in our goals. Economy or inputs is our budgeted cost per meal is 35 Rand and our budgeted overhead cost is 5 Rand. So our total budget cost per meal is 40 Rand. If we manage to get that done for 32 Rand per meal, our economy is 110%. We're actually doing better than what we expected. Obviously, if this cost was 50 Rand, the economy would be a lesser percentage. And then lastly, we are measuring how effective we use our inputs to get to our outputs. So our inputs was 110%. our outputs was only 80%. So our efficiency, our net efficiency is 88%. So although we didn't reach our output goal, we managed to save on our inputs and we increased our efficiency. And this is something you can measure on a monthly basis as well as on a year-to-date basis, just to see how good you are doing monthly and then overall for a specific period, how well you are doing. And so it measures your main goals as well as your financial goals to give you an efficiency ratio that you can report to internally as well as to funders externally, and that will just inform your task going forward. Then there are other goals that a nonprofit can also use that are not only those 3 E's. The United Nations have developed these 17 global goals, and you can look at those. Your measure might be the poverty in your area and how you are bringing down that percentage. That could also be a measure for a nonprofit. It doesn't have to be the 3 E's, and it doesn't have to be financial either. It can be a very qualitative approach to what you are achieving as a nonprofit. Then the last item was, how do we use technology? Now, technology is something that you can leverage to scale your accounting or for record keeping. It's very affordable in today's environment. And the great thing about it is that it helps you to create transparency, shareability, and ease of access for everyone that's involved in your organization, as well as external stakeholders. If we look at Xero, Simplified, and then some other tools. Okay, I see there are some questions. So Xero is something affordable. You can pay between 500 and 600 Rand a month for that. It serves as a document management system. You can upload all of your documents there. You can use it to manage your budget, which we talked about earlier. You can even connect your bank for a live feed so that you can have regular up-to-date data. There's built-in approval procedures if you want that segregation of duties, and you can even use a cell phone to submit documents. So it's really, there's no excuse for a nonprofit not to have great accounting records in place. Something like SimplePay is something for payroll if you have employees, and they help you with many of the compliance issues with SARS, the UIF, with COIDA calculations as well. And they also give additional discounts for nonprofits. And then other tools that you can use is G Suite, for instance. This is all online. You host all of your documents online. People can share it. You have tools like Sheets, a presentation, documents that you can use, and a drive, as well as email. And this can also be from 300 Rand a month. It's not that expensive. Office 365 is similar to G Suite. They have OneDrive. They've got your Microsoft apps that most people are familiar with, like Excel, PowerPoint, as well as email. And you can even use something like Dropbox storage that are free for a certain amount of storage. And then Airtable is another tool, as an example, where you can compile databases and you can actually keep documents in there. So you can use it as a document tool. You can use it for automation. And there's also a free version, and it can start from somewhere from 300 Rand. So I guess the main takeaway from here is that it is possible for all nonprofits to be able to comply internally as well as externally. These tools are available for them to actually use and to increase their accounting good practice, whether it's compliance, accounting, management accounting, or actually measuring their success as well. So I guess that's it from me. If there's any questions that's related to anything, I'm more than happy to answer. I think there was one.
Thank you so much. Yeah, there's one question here. Someone would like to know, they're wondering, does all the NPO types require a constitution? If one plans to start their own NPO, where's the simplest place to start?
Yes, so So yes, all NPOs, whether it's a voluntary association or an NPO itself, requires a constitution. If you register a non-profit company, you will have to complete what they call a memorandum of incorporation, which sets out your rules, and that will serve as your constitution. So I would definitely say you can start as an NPC. What's great about that is it gives you a lot of credibility because it's a legal entity that's recognized by the law. You automatically get an income tax number. Although it's a bit more work to comply, it opens a lot of doors for you down the line. It's easier to get a PBO number. It's easier to get a BE certificate. It's easier to open a bank account. I would definitely start at a non-profit company because you can then still be an NPO as well, or a non-profit organization. It is a bit more of administration work. You have to register directors, and you have to have at least 3 registered directors. But if you want a PBO status, you also need 3 people that accept fiduciary responsibility that are not related, so not married or brother or sister. That's the other important thing that I would do. But I would definitely start at registering a non-profit company.
And is this a process that can be done online, or do people have to physically go to offices to get these forms and fill them in? How does that work?
No, it can all be done online, and it's not that expensive either. You can use a company called Instant Company Registration. You can just Google that, and they do it for a minimal fee. I think it's less than R1,000. And if you submit all of the relevant documentation, it's less than 2 weeks, and they submit all the documents to the SIPC on your behalf. And they would, for instance, do all of the other registrations as well, like a PBO status.
Gerhard, I have a question on, I think if I remember correctly, you mentioned that accounting is not the only function within an NPO or a business. And since everything that you've taken us through, I'm just interested in knowing, how does like the accounting best practices influence the other functions of a business as well?
Yeah, so I think accounting is a great tool to inform your decisions that you are making, and to actually review where you are at the moment. I think sometimes non-profits can get lost in where they want to be, and because accounting gives you an unbiased version of the truth, it tells you this is how much money you have, this is what you've spent. Sometimes it's that reality call that you need to say, but what we are doing is actually not working. We need to relook at our costs or our initiatives, or maybe we need to rethink our approach because we are spending too much per beneficiary and it doesn't make economic sense. So I think accounting can help you to review what you've been doing, and then it informs your plan going forward as well.
Alrighty, let me just see if there are any other questions. There are no other questions. Oh, well, Kim saying that she loves the 3 E's. That's just a comment coming from her. Yeah, so there doesn't seem to be any other questions. Gerhard.
Yeah.
Thank you so much for the presentation today. It was very insightful. From just understanding the landscape of nonprofits, you mentioned, you touched on how the different kinds of nonprofits or the different kind of sort of the PBOs, the NGO, and what the difference is between all of those. So that was really insightful. And then also when you spoke about good reporting practices as well, good treasury practices, accounting management, and all of that, those were really good insights, and I really enjoyed listening to the presentation. So thank you so much for your time, and thank you so much for sharing all that information with us. So unfortunately today, Asanda is saying, thank you so much, Gerhard. This was really insightful, and I would also like to know how you didn't just focus on just one type of a business, but on everything. I'm not sure if that is a question. Hassan, I'm not sure if that is a question or a comment.
I think it's a comment.
Yeah, okay, cool. Awesome stuff. Alrighty, so it seems like that is all we have had time for today. So we will be sharing this recording on all our social media platforms. Again, I would just like to thank each and every one that has tuned into today's session. I personally have learned a lot. So thank you so much to everyone for giving us their time and attention. So please check out our social media platforms for more information about our upcoming episodes. In our next episode, we will be talking about tech hacks for nonprofits, a topic that I'm really excited about. So everything will be available on our social media platforms. So don't forget to follow us at Kwela Women on all social media platforms for further updates on our NPO Grow series. Thank you so much, Gerhard, and enjoy.
Thanks for having me. It was really lovely. Thank you.